It is currently Friday, December 5th. As we look at the charts this morning, the market has just digested the closing data for Beyond Meat Inc., ticker symbol BYND, which finished the last session at exactly $1.24, down 0.80% for the day. That number, $1.24, sits heavily on the screen. It is a figure that demands attention, not because of its magnitude, but because of its proximity to the psychological abyss of zero. The stock is currently trading in a tight, suffocating range, having touched a 52-week low of 50 cents and a high of $7.69. But the story here isn't just about the price falling. It is about the massive disconnect between what the retail public hopes will happen and what the institutional order flow is actually signaling. The expectation for a company like Beyond Meat, especially one that once commanded a market capitalization north of $10 billion during its peak, is that at these low levels, it must be a value buy. The narrative floating around social media forums and retail trading circles is that the brand is ubiquitous, the products are on shelves everywhere, and therefore the stock price must eventually reconcile with that visibility. Investors expect a turnaround story, a phoenix rising from the ashes, fueled by a global shift toward plant-based diets. They see the $1 price tag and think, lottery ticket. The reality, however, is far more complex and significantly darker. What we are witnessing is not necessarily a fundamental undervaluation, but a structural battle between a deteriorating balance sheet and a highly aggressive short-selling market that is using this stock as a volatility playground. The reality is that Beyond Meat has morphed from a growth darling into a zombie company candidate, where the primary driver of price action is no longer how many burgers they sell, but how many short positions are being covered on any given Tuesday. The stock isn't moving based on consumer demand for pea protein. It is moving based on the days to cover metric and the borrowing costs in the securities lending market. Let's look at the immediate price action we are seeing right now. That drop of nearly 1% to $1.24 might seem negligible to the untrained eye, a mere fluctuation of a penny. But in the world of penny stocks, which is effectively what BYND has become, that penny represents a battle for survival. We are seeing a consolidation phase after a massive volatility event earlier this week. Just days ago, we saw a speculative frenzy where the stock rallied significantly, nearly 48% in a short window, only to give almost all of it back. This is a classic bull trap. The price surges, retail investors chase the green candles expecting a sustained breakout, and then the smart money sells into that liquidity, driving the price back down to these lows. The resistance around $1.35 has proven to be formidable. Every time the stock tries to break that ceiling, a wave of sell orders hits the tape, pushing it back down. This tells us that there are large institutional holders who are looking to exit their positions into any strength, capping the upside potential. The volume profile confirms this. On the days where the stock is green, volume spikes. But on the days where it bleeds lower, the volume is consistent and grinding. This grind down is often more dangerous than a crash because it slowly erodes the capital of those holding a stock, hoping for a bounce that never sustains. The fact that the stock is hovering just above the $1 mark is critical. If it breaks below $1 and stays there, the company risks delisting from the Nasdaq, a process that would force institutional funds to dump their shares automatically, leading to catastrophic selling pressure. This $1 line in the sand is not just psychological, it is structural. Now we need to address the elephant in the room, the short interest. This is the single most important metric for anyone even thinking about touching this stock. Beyond Meat is one of the most heavily shorted stocks on the exchange. A significant percentage of its float, often oscillating between 30 and 40%, is sold short. This means that nearly 1 in every 3 freely tradable shares has been borrowed and sold by someone betting the price will go lower. When you see short interest that high, it creates a unique dynamic called a coiled spring. The shorts are betting on bankruptcy or further dilution. However, if any positive news hits, a new partnership, a favorable CPI print, or even just a rumor, those shorts rush to the exit simultaneously. They have to buy the stock back to close their positions. This buying pressure, combined with retail FOMO, causes the vertical spikes we see on the chart. But here's the warning. These spikes are almost always transient. They are technical events, not fundamental shifts. If you are holding shares or considering an entry, you need to check the borrow rate. This is the interest rate that short sellers pay to borrow the stock. Recently, we have seen these rates spike to double digits. When the cost to borrow rises, it squeezes the profit margins of the short sellers, making them more likely to cover. If you see the borrow rate climbing while the stock price is stable, a squeeze might be imminent. Conversely, if the borrow rate drops, it means there's plenty of liquidity for bears to keep shorting, which is a bearish signal. I want you to pause right now and engage with this idea. Comment below with your take. Do you think the high short interest in Beyond Meat is a trap for the bears about to trigger a squeeze? Or is it smart money correctly predicting the end of the company? I want to see how many of you are playing the squeeze versus investing in the company. Now, shifting gears to the macro environment that is crushing this company. The expectation was that as inflation cooled, consumers would return to premium grocery items. The reality is that the consumer psyche has fundamentally shifted. We are seeing a trade-down effect that is sticky. When a shopper stands in the aisle and sees a pound of real ground beef for $4 or $5 and a pound of Beyond Beef for significantly more, sometimes nearly double depending on the retailer, the choice becomes economic, not ethical. The inflation of the past few years has eroded the purchasing power of the middle class, the core demographic for mass-market plant-based adoption. Beyond Meat is a premium product in a discount economy. That is a mismatch that marketing cannot fix. Furthermore, the health halo that used to protect the brand has slipped. In the early days, plant-based meat was viewed unequivocally as the healthier option. But recently we have seen a counter-narrative emerge regarding the processing levels and ingredient lists of these products. Whether scientifically meritorious or not, the perception has shifted. Reality is that consumers are turning back to whole foods, chicken, lentils, beans, rather than processed alternatives. This creates a demand ceiling that the company is struggling to break through. Let's look at the company's recent financials to understand why the stock is at $1. In the third quarter of 2025, the numbers were, frankly, alarming. Net revenue came in at roughly $70 million, a double-digit decline year over year. But the real shocker was the net loss, which widened to over $110 million. Think about that math for a second. They brought in $70 million in sales, but lost $110 million on the bottom line. You do not need a CFA designation to know that this is unsustainable. The company burned through cash at a rate that has investors sweating. They also took a massive impairment charge of nearly $77 million. In plain English, this means they admitted that the assets on their books, factories, inventory, equipment, were worth far less than they previously stated. This is a capitulation. It is management admitting that the growth they planned for is not materializing. The gross margin profile is another disaster zone. Margins have collapsed from the healthy 30s we saw years ago to the low teens, and in some quarters they have even flirted with negative territory when factoring in write-offs. When you have low margins, you have no buffer. Every operational hiccup, every supply chain snag bleeds directly into the cash balance. However, there was a glimmer of activity in October 2025 that gave traders hope: the debt restructuring. The company executed an exchange of convertible notes to reduce its immediate debt burden. This was a classic kick the can down the road maneuver. By swapping near-term debt for longer-term obligations or equity, they bought themselves a runway. This is why the stock didn't go to zero in November. It's a survival tactic. But restructuring is not a growth strategy, it's a life support mechanism. It dilutes existing shareholders and signals distress. So, what is the future outlook? We have to look at two potential scenarios. The bull case is narrow but possible. It relies on the company successfully shrinking itself to profitability. This would mean abandoning the goal of massive growth, cutting costs ruthlessly, and becoming a niche player for a specific loyal customer base. If they can stabilize cash burn and stop the bleeding, the stock at $1 is undervalued relative to its brand equity. There is also the potential for an acquisition. A major